Welcome back to EDS, and in this video I'm going to show you step by step how to turn losing trades into winning trades. Now at EDS we write options contracts, which means we are short the options contracts. Now a lot of people are concerned about what do you do when the trade moves against you. You have unlimited loss potentials, etc, etc. I'm going to show you how to manage that and why you don't need to worry about it. So this is a live portfolio that we've been working on. As you can see, there are only 3 positions in this portfolio. There were a lot more. This is a Sunday. Every Sunday we do like to do a portfolio review, and from last Sunday you'll notice that there are a lot less positions, and that's because we've managed to work those positions either into a take profit situation. We've managed to work losing trades into either break evens or small losses, and this is basically what we're left with. So I'm going to go one by one into each position here and show you what's happening, how we're managing it, and what the plan is. So when you initially start out with a trade, with a position, we typically like to be around probabilities of success anywhere between sort of 65 and 90%. That does mean that most of the time we will win. However, sometimes things will move against us, and I'm going to show you what to do in those instances. So we've got a futures position, which is the first one is the Euro futures. We've got GDX and we've got Macy's. So the first position here, which is the Euro futures, is an iron condor position. We have made some adjustments, and on this recent adjustment from the current position we're up 3.4%. If we have a look here, our net delta is negative 13, which is perfectly fine. It has an IV rank of 60. We've been in this rolled position or managed position for the last 6 days. There's 75 days left on the contract, and this is what the current position looks like. So if you open up the chart, let's have a look and see what's going on here. So this is the current position as it stands, and if we open up the order chain, we can see what's been going on here. So we open up the initial position with our short strikes at 1.035 and 1.09, and then what we did here was we rolled the call side. So we bought back the 1.09 short, we bought that, and we sold the 1.095. So remember, whenever you're rolling a position, that a roll is simply simultaneously closing one position and opening another. So we did the inverse of what we did to open the call side, and then we rolled it down to the 1.06 and 1.065 strikes, which is where it currently is sitting right now. And we also rolled it out to the April 4th expiration date. Now what that did was it allowed us to collect a nice premium of 0.001. Now don't be put off by these numbers, because these numbers you have to multiply them out by the contract multiplier, and for currencies it's in the hundreds of thousands. Okay, so what we've done here is we've collected a nice 0.001 premium, which brought our total premium up to 0.0027, and our initial premium was 0.0017. And then what we did was, and the reason why we did that is because price came down and kind of messed up our deltas a little bit, and I'm going to show you what I mean by that in just a second. So we rolled down the call side to kind of rebalance our deltas, and then what we did was on the put side we rolled the put side down and out as well. So we rolled the call side down and out, and we also rolled the put side down and out. So we closed the 1.03 long, and then we closed the 1.035 short. Remember, it's the inverse of what we did initially. So if you sold a contract initially, to close that position you need to buy it back. And then what we did was we opened up another spread, our short strike at 1 and then our long strike at 0.995. And this is what the current position looks like. We rolled it down and out, and we paid 0.0022 to do so in the process. So overall on the position we have 0.0005 in premium. Now this is a covered position, and we rarely make these kind of adjustments in a covered or defined risk position. We normally do this in an undefined environment. However, volatility was nice and high, and in hindsight, I don't think this is a bad roll. This is a respectable roll. However, we could have also left the position as it was, because our risk was defined on entry. So we didn't have an unlimited loss potential on this position. We could have just left it as it was. On entry, we were happy to take the max loss, and that's the benefit of a defined risk position. However, I thought I'd just make the adjustment because we could. So we still have some premium in the position, which is less than what our initial premium was on the position, and that's typically why we don't make these adjustments on defined risk positions. If price moved against us at this point, we wouldn't really make another adjustment because there's not much premium left. We just want to get out of this thing at either a small profit or a break even. We did also have to sell time, which is why there's still quite a bit of time left on these contracts. So it was kind of like another shot at rolling the dice and seeing if we could get out at a scratch or slight profit. Basically, that's what the logic was behind this adjustment. So this is what the current position is. We are in a slight loss here of $190, but that's because we've got so much time left on the contract. The main reason, or the main thing to take from this, is that we have brought our deltas back in check, and our short strikes are now out of the money, and so we've removed the risk from that point of view. As you can see here, our delta is it was in the hundreds before, now it's down to 13, which is perfectly manageable. So we would typically look to manage positions if our net delta gets either to a positive or negative 30, anywhere between 30 and 50. We would look to make an adjustment and reduce our delta exposure by between 30 and 50%. So that's nice and easy to remember. If your delta goes above or below 30 and 50, between 30 and 50, you want to reduce your delta exposure by anywhere between 30 and 50%. And that's basically the euro futures, and that's how we've managed that, because there's still 75 days left on the contract. Everything is absolutely fine. IV rank is nice and high. Hopefully we can get a contraction in IV, let theta decay away the contract. Our delta is in check, and now we just need to wait and let theta and volatility do what they need to do. So next up, we've got GDX. GDX is a strangle. Strangles are much easier to manage, in my opinion. If we have a look at GDX, let's look at the order chain. Well, let's just go over what's happening here first. So we've got a net delta of negative 21, which is perfectly normal. We have a nice IV rank of 41, so there's still some contraction that can come into play here. We've been in this position for 19 days, and there's 33 days left on the contract. So let's just have a look at GDX. So our short strikes are at 38 and 34. Let's open up the order chain. So we initially had a position. The initial position was at 31 and 38, and then price moved up. Our strikes hadn't been breached, but our delta was slightly high. It went into the 30s. So what we did was we reduced our delta exposure, and we rolled the put side up to balance out our deltas. And we collected some premium in the process. So we rolled our put side up from 31 to 34, collected 34 cents in premium, and now we are sitting with the current position with our strikes at 34 and 38. We've got $1.25 in premium. Our current mark price is $1.27, which means we are basically at break even on this position. The total P&L on this position is minus $2, which is absolutely fine. This is a perfect situation for us. We've managed to collect more premium. We've managed our deltas closer back to delta neutral. Volatility is pretty nice and healthy, and there really isn't anything to do on this position. This is a perfect textbook management situation thus far. And again, we just need to wait and see what price does, or not what price does. We just need to wait and see what volatility does, theta does, also what price does, I guess. If our delta does increase or decrease in this situation, because it's a negative 21 delta at the moment. So if it does go down by a further 9, 10 deltas, if it gets to negative 30, we will look to make another adjustment and roll the put side up further. If we get some positive deltas, if price comes down a little bit, we'll get back to delta neutral. It's absolutely fine. We're not trying to predict where the market's going to go. We're just managing delta, managing theta, managing volatility or vega, and that's basically what we do here. We just manage the Greeks, and the market's going to do what the market's going to do. So next up, we've got Macy's. As you can see, is in the money right now. We are sitting. This is a naked position as well. This started off as a strangle. We are now in a straddle. And when you're in a straddle, one side is always going to be in the money, but that's absolutely fine. So we've got a negative 4.44 delta. So delta exposure is really nice on this. IV is at 21.2. This was much higher when we put the position on, so we've had some volatility come out of this position. We've been in it for 5 days since our last adjustment, and we've got 33 days left on the contract. So this is what Macy's looks like right now. Both of our strikes are here at 14, as you can see. And if we have a look at the order chain, let's see what's been going on. So our initial position was at 15 and 20. Our put was at 15. Our call was at 20. So then what we did, our delta exposure got a little bit too high. So what we did was we rolled the call side down from 20 to 17, rolled it down from 17 to 15, just because the reason why we did this was simply because rolling it down to 17 was fine, but we got a lot more premium when we rolled it down to 15, so we just took advantage of that. And you want to always be cognizant of what prices you're getting filled at. If it makes sense to go an extra strike because you get paid a lot more for it, it might be worth doing so. And if we look here, we got paid 7 cents for going down $3, and then to go down another $2, we got paid another 59 cents. So it just made sense to make that adjustment. And then what we did was our delta exposure got a little bit high at that point. So what we did was we rolled our put side down. We rolled it down from 15 to 14. So then the position at that point was 14. Our strikes were at 14 and 15. And then what we did was our delta exposure increased again. So then we rolled our call side down from 15 to 14 to the current straddle that we are in right now, and collected another 32 cents in the process. So we collected 57 cents on entry, then collected another 7, collected another 59, paid 57 cents. And don't be afraid to pay to make an adjustment, as long as you have enough premium still left on the overall position. You don't need to necessarily collect a credit on every single adjustment. As long as you still have a nice healthy premium in the overall position, it's absolutely fine. So as you can see here, you collected plenty of premium at this point. It's perfectly fine to pay 57 cents to manage to reduce our delta exposure. And then we collected even more credit by rolling down the call side into the current straddle that we are in right now. And as you can see, we have managed our delta exposure. Our delta exposure is basically zero. It's negative 4.44 right now, which is absolutely fine. And we've got 98 cents of premium in this position. When we opened it, we had 57 cents. So we've got more than what we had on initial entry. Our current mark price is $1.34, so we're down $36 on this position as of right now. However, which is pretty much which is not an issue at all. Still plenty of time left on the contract. As theta decays, as long as we keep our deltas in check, as theta decays, and as theta gets more aggressive close to expiration, we're going to see this position turn green very quickly. So that's how you essentially manage a position. And this order chain here, for anyone that is curious of how to get out of an unlimited loss situation, or not get out of an unlimited loss situation, but manage an unlimited loss situation. This here, take a screenshot of this. This is another textbook way of managing your undefined or naked positions. It's all about reducing your delta exposure. It's all about following the market. Don't let the market move away from you too much. I mean, if you have a look here, look at what happened with Macy's. We've had a very steep drop. However, we've got more premium now in the position than what we had when we opened it, and we're basically delta neutral, which is where we were when we opened the position, and look at how much the market has moved. So this is why, if you know how to manage risk properly, the unlimited loss potential shouldn't scare you. And having a naked position is actually easier to manage, in my opinion, than a covered position. But that's just the trade-off. You do kind of need to know what you're doing. So that's Macy's. We've got 3 positions here. And we're just going to manage those and see what happens, and then look to sell some more strangles over the next week or 2, and just keep building up the account. So how do you know how much to allocate to your positions? Because it's all well and good knowing how to manage risk, etc., etc. However, black swan events do happen. Unforeseen circumstances do happen, and how do you ensure that you don't get wiped out in any instance? Well, we've got a free position sizing template that's available for everyone to use. The link is in the description. Just click the button and it will take you over to this spreadsheet. The way it works is you enter in the size of your portfolio. So say if you have a small portfolio of $5,000, you can then enter in whatever the current VIX level is below it, and everything will be automatically calculated for you. It will tell you the maximum amount to be allocating to any single defined risk, undefined risk position, how much of your portfolio that you should be allocating to short premium strategies in general. And as long as you're following this, you'll be absolutely fine. If you would like to learn in more detail about what we do and how we do it, click the link in the description. Click on EDS Premium, get yourself signed up. Inside, you will have access to our portfolio that will allow you to see what positions we're placing, how we're managing risk, how we're making adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so if you get stuck, you can speak with myself directly or with other like-minded individuals. And there's also a 100% money back guarantee. So once you have studied the full course and followed some of our trades, if at that point, after 6 months, you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. And it's £1 a month to join right now. It's super cheap because we've just launched. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And the aim of EDS Premium is to teach you the skill, to give you the knowledge. It's to not keep you dependent on us. It's to give you the skills so that no one can take it away from you. You know what to do. You don't need any external help or influence. And once you get to that point, it's something that you can take with you for life. It's something that you can do for the rest of your life. And we aim to get you to that point within 6 to 12 months. You're always welcome to stay and be a part of the community, but within 6 to 12 months, you should be good to go. So with that being said, I will see you guys on the inside.